All right. So I'm being honest, I spent about a month pulling this together. Um, I pulled and looked and read a lot of information to try and give you, as I do every year at this time before the holidays, an outlook as to where we are, where we're headed, and what the future looks like. I say I try and do it like a crystal ball. Sometimes I'm pretty spot on, and sometimes the ball gets a little fuzzy because there are things that happen that I don't predict. Like, remember 2 years ago, what happened in February? There were some world events that occurred, and all of a sudden it threw the mortgage rates out of control, and then the market fell out from underneath us. Didn't predict that. Um, Having said all that, I will say this with a caveat. All of it is based within the information that we know today. If something pops off that we don't see, i.e., a world event, hard to predict. And there are some things happening right now down in South America that you have to be paying attention to because who knows where that might go and how it impacts our capital markets. But so here's my stab at creating a crystal ball for you. Before we start, I'm going to take a look back in terms of what I did, what I told you last year to help you understand where I think my accuracy in some of these predictions are. Last year, I said closed units will be up mid-single digits. Here was the reality. We'll finish around up 1 to 2%. I made that yellow or orange because we never got to the 3 to 4% that I was hoping or expecting. And yet, when rates dropped in September, it helped increase the amount of activity within the marketplace. Cole's dollar volume last year in December, I told you it would be up 7% or more. The reality is we're going to finish at 9%. I'd say that was pretty spot on. Last year, I told you rates, you should expect a downshift that will create an opportunity from a refi environment. You just heard from Blake. Last year at this time, they were at 7.1. Today, they're at 6.1. So that prediction kind of came true based on the information and research that I did. And then I shared with you housing, some commentary as it relates to housing as an asset and regional population. So I'm going to take a stab at a few things for you to give you some insights in terms of what I'm seeing, what I'm reading. And you're going to see this. I'm going to be totally transparent with you that is not the most beautiful of presentations because I begged, borrowed, and stole a lot of people's prognostications. I totally butchered that one. But I took a lot of their research to then say, what is it that we're seeing within the data that we experience in southeastern Wisconsin? And the yellow boxes are my own personal commentary for your line of sight. So, what's going on in the economy? Here's what you need to know. Okay. Is within the economy, this is total payroll jobs as of August, which is at a record high. This is across the US. Okay. You can see the depth of which the jobs have increased across the US. Why is this important to us? People need to be gainfully employed in order for them to afford housing. Okay, very simply put, from an economic standpoint. When you look at it, job gains since pre-COVID in the state of Wisconsin, we're up 2.9%, which is relatively decent and healthy as it relates to where we sit versus our Midwestern peers. Obviously, there's been a lot of things and a lot of discussions around Texas, Florida, and the Southeast in particular. But you can see from a Wisconsin standpoint, within gainfully employed people, we've had nice job growth within the region. Okay. The other thing I'll touch on is the unemployment rate. And this is important to know because people need to be gainfully employed in order to be able to afford housing. When you look here, the blue line is the US unemployment rate. The green line is the Wisconsin unemployment rate. What you're noticing is the gap between the two is what? Widened, which is a good thing within our economic region because it means that we have a very effectively a gainfully employed economy within southeastern Wisconsin. Remember the baseline for unemployment, a gainfully employed economy is 4%. In Wisconsin right now, we're sitting at 3.1%. So from a regional perspective, the region is outperforming the country as it relates to unemployment metrics. Good things. Okay. The challenge of it across the country is we haven't seen a lot of job growth. There's been a lot of uncertainty within the current administration as it relates to tariffs. If you have, if you don't know this, Wisconsin as a whole, by far and away, the largest sector that we have is manufacturing. The number one sector that has been impacted by tariffs is manufacturing. So job growth has slowed a little bit, twofold. One, because we have a effectively a gainfully employed region, but also twofold. There's been a lot of uncertainty as it relates to capital costs and how do you allocate capital? Do you put it towards headcount or do you have to account for these tariffs? More to come on that. We'll see, especially after being 12 months in within this administration, but things to be thinking about as it relates to our macro economy. The other thing as it relates to good news, bad news is this is overall wage growth, okay? And overall wage growth across the entire US economy. The reason why this is important is this is a really key indicator as it relates to inflation. If you think about inflation is directly correlative to wage increase. So if you look here from 2022 to effectively 2023, what happened? Let me say this, 2020 to 2023, wages and job switch wages, right? When people jumped jobs to make more money, was on a tear, which then increased inflation. And all administrations, because it's an apolitical statement, want to curb inflation. So what happens then? They pull a bunch of levers in order to not derail, but to slow down wage growth to help curtail inflation on the cost of goods, products, and services. Because when a company pays its employees more, that cost of labor is passed on in goods and services to the consumer. And so they have to curtail the trend in which that wages were growing. For example, let's just talk about your foundation specialists or people. Think about what that cost 5 years ago versus what it costs today. Foundation specialists, just say Vret, Ein, Budiak, whoever it might be, your plumbers are now making close to $180 to $200 an hour. When 5 to 10 years ago, it was about $100 an hour. And so wage growth is an important metric that we look at within the macroeconomic conditions to understand what is happening with inflation. Okay. Personal consumption expenditures, because of that, then has since gone down. So what's happening is we have this weird counterbalance happening. We have to curtail wage growth, but at the same time, we want people to continue to spend. It's a delicate balance to figure out, which is why when you look at the GDP has started to slow. So a few things to point out or to pay attention to. GDP growth has been good, but there's been some concerns because it's started to slow down. Employment growth is broadly weak, but the unemployment rate remains low. So we want to create jobs, and we also want to keep unemployment low. Again, delicate balance and tricky to figure out. And inflation continues to remain a concern. I think part of this might be a recency bias, but also part of it might be from an administration standpoint as it relates to the handling of tariffs, because tariffs are then passed on in goods and services to consumers. And so there's a balance there. Economic uncertainty is coming from continued flow of executive orders. And again, this is an apolitical statement. I'm just providing you data and information. Few things to pay attention to. There's lots of uncertainty. The economy likes certainty so that people can make bets with their money. And when you have uncertainty, it creates a little bit of, I don't know, chaos is maybe a bit extreme, but a little bit of chaos. So what's going on is the current administration is looking for quick fixes or quick wins, and they're making decisions based on the stock market and bond market response. Now, if you look at your portfolios within the S&P 500, for just round math, the S&P 500 was up roughly 20% this year. And so there's all these sorts of things that are going on, and at the same time, the capital markets have been really healthy. Okay. And so when you see these executive orders, it's been focused on growth at all costs, tariffs and tariff indecision, and the threat of from a deportation standpoint, it creates inflationary pressures because 24% of all construction workers are undocumented. So again, using construction as a goods and services labor product, you see where the inflationary pressures start to come into play if certain industries are impacted as it relates to administration decisions. And again, I just would say it's an apolitical statement. It's just kind of where we are, and we have to face the facts of where we are and how do we navigate it within our industry. So let's just take a quick look at mortgage rates. Okay. Question for you. Today's 6.17% 30-year mortgage interest rate is about 1% higher than the Great Recession, about the same as the Great Recession, or 1% lower than the Great Recession. Anybody want to take a stab? It's about the same as the pre-Great Recession. Where does this show up? Here's how it shows up visually. When you look at the period from 2000 to effectively 2008, the average of a very, very healthy residential real estate market within our very recent history, the average mortgage rate was 6.1% from 2000 to about 2008. When you look at where we are today, we are at 6.17%. That still rings true, effectively 6.2%. The other thing to pay attention to, because, and this is more so of the recency bias, and I haven't heard this as much as of late, but it's just a good visual for people to understand when you have conversations this holiday season and people might be asking as it relates to affordability, is delinquency rate within mortgages and foreclosures are substantially low. So despite the fact that rates jumped pretty substantially, we've had some concerns as it relates to student loan debt, and we'll talk about first-time home buyers. Delinquency rates are relatively rather low, which again, healthy indications for our industry. And here's a really interesting slide that I pulled from Housing Wire. This is the mortgage purchase application index through effectively the beginning of December. And what do you notice? Applications are an indication of demand and an indication of people who want to buy homes. So this showing you over the last 18 weeks, when you compare it 25 versus 24 versus 23, the indication of demand as it relates to mortgage purchase applications are up substantially, which means what does that tell us as we head into 2026? It is signaling to you that demand metrics are still healthy and relatively strong when we look at it versus the recent markets that we had of 24 and 23. Another way to look at it is this is the weekly mortgage applications to buy a home. And this is a percentage change versus prior year versus the year ago. And I've always shared with you, I like graphs that go on the bottom, on the left, start on the bottom left and go to the upper right. Applications equal demand. It's an indication of people who want to buy homes. That's a good trend line as we head into 2026. So, rates, from a rates perspective, I'll create a synopsis for you here at the end, but I like what I'm seeing from an application standpoint. I like what I'm seeing from a stability standpoint. The stability of the rate now is going to create predictability for us heading into 2026. So let's look at industry sales metrics. This is the, going back to 2015, here's what you look at in terms of home sales nationally on an annualized basis, okay? And I'm going to visually help you understand what this looks like. For the last several years, from 2015 to effectively 2022, we averaged north of 5 million homes sold a year, okay? And when you look back then to what we've been experiencing from 23, 24, and 25, we were experiencing about 4 million transactional units across the US, okay? So when you look at that, over a 3-year span, we lost 1 million transactional units times 3 years. We lost 3 million overall units in 3 years. Transactional units that would have happened across the US. Now, when you seasonally adjust it, this helps you understand just basically how big of a drop that we experienced from 22 to 20, effectively 23 to 24, right? There's the 5 million home mark. Again, seasonally adjusted. This is the same data I'm just showing you. It's just flatlining it across the, on an annualized basis. Here's where the 4 million home mark is. And when you look at it, you don't understand this. You've heard this phrase, you don't know how good you have it until it's effectively gone, or you don't know you're in the good old days until you're out of the good old days. The window of 2020, 21, and 22 were exceptional periods of time, and they were short windows. And I'm going to make a broad comment to you. If your business grew or was flat from a units perspective from 2022 to 2025, you took market share. Factually true. If your business grew or was flat from a units perspective from what you finished in 2022, which was the last peak of the market, to where you will finish in 2025, if you just look back at that 3-year history, if you grew or you were flat, you took market share. You won. You won. And it's important for you to understand and recognize that, because sometimes at this point of the year, I know many of you are like, holy shit, I just feel like I just got beat up for the last 12 months. But the reality is take stock in where you were and where you are and where it is that you stand from a market share position. Most of you are in a very good position. Okay. When you look at it from a Wisconsin perspective, we're very similar trends. You can see for the last 3 years, we've been at 10-year lows in terms of transactional units across the state. The state story mirrors the national story that I just walked you through. And so effectively, we're missing 1 million transactions a year for 3 years. We won't have them, and now we have to try and make that up. But the good news is if you grew or you remained flat, you grew your market share. You grew your market share. So what happens as the tide rises and you took market share? You are setting yourself up for continued success as to what the next 5 years look like, which, by the way, I'm very bullish on. So switching gears as it relates to listing inventory, it's down dramatically from a decade ago. If you go back to 2017, we averaged around 36,000 listings a year across the state of Wisconsin. When you look at it at its bottom, we were at 8,000 listings. You can see the dramatic fall off in effectively a 7-year period. Now, here's the good news for you. And it's been rising since 2023. Okay. So what does that mean for us, and what are the metrics that we need to be paying attention to? And this is kind of what I've been hammering you for the last 60 days, is you have to understand across the country and locally, days on market are rising because of this factor. Okay. And I've shared with you the localized data, which I'll share here in a second. But again, we can't lose sight of the fact that because, yes, inventory has been declining for a decade, but yet now it's rising over the last 2 to 3 years, you have to recognize that the experience that we've all had in terms of the velocity and rate of sale of the markets that we've operated in might take longer because of the increase in inventory that we're experiencing. The problem is, for most of us, we're operating in the mode of what we knew from 2019 to effectively 2022, where the industry was going really down pretty substantially from an inventory perspective, which created a lot of compression, which then created a really fast market. Okay. Now we have to be ready for a slow rise of inventory, which means things might take longer. Where this shows up then, days on market from a seasonality perspective, here's Wisconsin's supply of housing inventory as it relates to months of supply. And when you look at it, I'll walk you through this from the left to the right. Metropolitan areas, which I would argue we all live in a metropolitan area, you can see from last year to August of this year, it rose by almost half of a month, 3.2 to 3.6. When you look from a price point perspective, you can see how things rose from a months of supply inventory based on price point across the entire state of Wisconsin. And then when you look at it specifically within southeastern Wisconsin, you can see how days on or months of supply inventory has rose from last year to this year within just a single year. I expect that trend to continue heading into 2026, which isn't a bad thing. It just means more inventory is coming to the market. Foreshadow. And then I pulled the localized data where I've been showing you that this trend is continuing. So I looked at it from a national level to a state level to then a localized regional level to give you this information. The other thing I've been hammering you about in the last 2 months as it relates to price reductions from listings, price to contract, and then closing. And when you just look at it in terms of where as inventory is rising, how this is impacting people, I want you to focus here. Price reductions from list to close as it relates to days on market. And this is just from September of this year to October of this year. So you can see how quickly this data is changing as it relates to price reductions. Metrics you need to be paying attention to heading into 2026. And I shared with you the localized data that I shared with you last week. All right, what's going on with pricing? Question 3. Home prices over the last year in the Midwest have underperformed the Sun Belt, underperformed the Sun Belt by 2, outperformed the Sun Belt, or outperformed the Sun Belt states by 5 as it relates to home prices. Ding, 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 ding. D. Now, here's the crazy stat. Since over the last 5 years, home prices since pre-COVID to where we are today, the state of Wisconsin is up nearly 64%. Now, when you compare that versus a lot of the national information that is shared more broadly as it relates to the Sun Belt states, Texas, Arizona, California, we are very well positioned as it relates to people's assets on their balance sheets and what they're buying and what they're holding. Okay. So now here's another interesting thing. Wisconsin specifically, when you compare it versus the US price appreciation gain line versus Wisconsin, what are you noticing? There's been an interesting trend over the last 12 months, a separation. So I'm going to just quickly recap for you. Unemployment in the state of Wisconsin is outperforming the national metrics, which means we have people that are employed. And real estate is appreciating faster than what the national averages are, which means we know that mortgage applications are really strong right now. So what does that mean? It means we should be operating in an environment where moving forward into the future, the state of our economy as it relates to residential real estate should be relatively strong because with the foundational principles that are there. The other thing that you need to be paying attention to as it relates to your personal businesses is how are you increasing your average price points? Why is this important? Because if you look here on a home sales change by price category, you can see that the high end of the market is what's actually driving the market as it relates to the activity within the market. The reason this is important is also correlative to the performance of the stock market. So what's happening is people's stock portfolios are doing well, and where are the wealthy putting their money? Into stable assets that are appreciating, real estate. So the high end of the market has outperformed the overall market in the last 12 months. It's an indication of consumer confidence in the asset class. Typically, the high end from a price point perspective is the most educated buyer or most educated consumer as it relates to what's going on in the macro economy. And this is the indication that they're telling you they're putting their money into stable assets as they've done really well over the last short term 2 years as it relates to their stock portfolios. This is very good. I look at this because you know what's really interesting? The first market to tell you that the market's going to slow down is the high end. And the first market coming out in terms of a boom is the high end. Okay. And this helps you understand when I share with you this data, why I share with you this data and why it's an important strategy for us from a luxury standpoint and why we continuously focus on it, because it helps drive the housing economy. Despite the fact that it's a small percentage of the overall economy, it's the leading indicator of what is going to happen within our southeastern Wisconsin metro area, which is why luxury is such a focus for us because it helps us understand luxury is the first into a recession and the first out of a recession. Lastly, this is some data, and then I'm going to switch into demographic information for you as it relates to real estate and net worth. You hear this all the time as it relates to homeowners' net worth versus renters' net worth. This shows you over the appreciation gains that we've had over the last effectively 25 years as it relates to the asset, why it's a buy and hold economy. You want to buy real estate and wait. And then this shows you the American success between the median net worth between owners and renters. And quite simply, because of the appreciation gains and the stability and predictability of the asset class that real estate provides, it's a no-brainer as it relates to helping people unlock the American dream. The challenge of it is the American dream is becoming more unaffordable. You have student house debt, you have insurance premiums that are continuously rising, and our jobs moving forward is complex from the standpoint of how do you help people navigate their situations in order to unlock the American dream. That's the beautiful thing about what you get to do. Your challenge becomes is how do you articulate it and communicate it in a way that people view you as their fiduciary, not a transactional relationship. And so how you advise your clients in order to access this will be, I think, more important and more of the burden moving forward because there's a lot of complexities as to why the housing market has become so unaffordable. But the way that they unlock this equity as it relates to the American dream and their median net worth is what our jobs are and what our jobs will be moving forward. Lastly, this is why I'm very bullish on where we are and where we're going in the next 5 years. Demographics are completely in play, and yet we have some headwinds. Question four, first-time homebuyers in 2024 are up 50% from the 24 average, up 25% from the 20-year average, down 25% from the 20-year average, or down 50%? D, down 50% from the 20-year average. Okay. This is the headwind. And this is where I'm saying that you have the opportunity to be the economist of choice, someone's true fiduciary, and not a transactional relationship. Because the complexities of helping people unlock the opportunity in real estate is where your value creation will occur moving forward. Okay. First-time homebuyers are on a 20, first-time homebuyers are half the 20-year average. This is the missing million. So when I talked about earlier, we went from a period doing 5 million transactions to 4 million transactions. The reason being is the unaffordability or the inaccess to the real estate economy as it relates to millennials, quite frankly. You'll see that here in a second. Median age of home buyers, also, we've talked about this over the fall, is thinking about how you're demographically segmenting your database and communicating to them in different ways. Demographically segmenting your database and communicating to them in different ways. Why? The average age of a first-time home buyer last year was 38, and the average age of all buyers was just surpassed the age of 60. Buyers, first-time and all buyers, ages are at an all-time high. So people from an age perspective are moving up in terms of their transactional history. Again, the complexities of how we articulate, how we help them unlock access to owning a home. Mobility, the other piece of it is because of the incidence of healthcare, drugs, and so on and so forth, people are aging in place longer. And so mobility rates by a housing tenure across the US have dropped substantially in terms of how often people are moving and people are aging in place. Question 5, what percent of US households are married? 47%, less than half. So again, demographically segmenting your database is where I'm trying to get you to think about this. Okay. First-time marriage, which is when a household creation happens from 1980 to present, it's the highest it's ever been from an age perspective. First-time home buyers with marital status substantially has dropped off. So again, demographically segmenting your database. Okay. Married couples, unmarried couples, single females, single males. Single females, take note. Married households are now 47% of the households, down 78% since 1947. Now, here's the one chart that, okay, you're saying, okay, this is a lot of information, this is a lot of data. If I were to tell you to just lock in on one thing on why I'm very bullish over the next 5 years, it's this, and I'll walk you through it, okay? You have to look at this in terms of the people across the total US population by generation. Okay. And I just shared with you that all buyer activity, the average age of all buyer activity was 60 last year. Okay. 60. So when you consider it, the 50 to 65-year-old is the one who's actually transacting at scale from an age demographic standpoint. Yet at between the ages of 70 to 80, and again, if you look at that bar graph, that's the current US population, and you look at who will be coming into that US population shortly, you might have heard of the term the silver tsunami. We're entering into a period where that turnover is about to occur because of the size of this generation that will be coming of age. Now, here's where you also need to be paying attention. And this is why I'm bullish over the next 5 to 10 years about our industry. Is these people are currently transaction, but they will soon be considering housing alternatives. Okay. This generation is the 10-year future because it's the largest generation. It's larger than the boomers and Gen X's, and they are coming of age. And the 20 to 35-year-old, remind you, the average age of a first-time home buyer was 38. So if you look at the 20 to 35-year-old demographic that is coming into our opportunity zone from an age and demographic standpoint, when they get married, when they create households, when they get divorced, all of that will be forthcoming to us within the next 5 to 10 years. The game is a game of patience and a game of the infinite game, which is what I preached to you from 2022 to effectively 2024. Be patient, be patient, be patient. These games are cyclical. Okay. So here's my 2026 predictions for you. I'm bullish on the market from a closed units perspective. I think it'll be up 4% or more. The reason why I say that is the alleviation of rates and some other things that I'll talk about here in a second. Closed dollar volume, I think we're going to still hover around 7 to 8% or more. I just look at the unemployment rate in the southeastern Wisconsin. I look at job creation in southeastern Wisconsin. I look at the tax policy around the 94 corridor and the amount of businesses that are moving just over the Illinois border into Wisconsin. And a somewhat controversial topic, the amount of data centers that are looking to open in southeastern Wisconsin is going to continue to create increased job creation, which is where I think demand shows up. Rates, I think they're going to stabilize right around 6%. I have a hard time seeing the data where it's going to go below 6%, but you never know with what's going on and how those levers might be pulled. But they could. But I think it'll be right around 6%. And I think the stability of the rates and the environment of creating stability will create predictability, which is healthy for us. Inventory is a listing agent. You got to be paying attention to your inventory because more inventory is going to continue to what I call de-thaw and unlock. I expect it to increase. Life events will alleviate the inventory of rate locked homes, marriage, more kids, death, divorce, job change, etc. Of those that were sitting on the 3% interest rates that didn't want to. The further we get from that, the more life events that will occur. Two, and this is a bold prediction, I think the current administration will create some sort of tax policy incentive to get inventory turnover. I don't know what that is. I don't know what that looks like. I don't know if it's a capital gains. I don't know what, but I think they will create some sort of tax incentive because housing is the largest lever they can pull to increase GDP. And with slowing GDP, they're going to want to unlock inventory in order to stimulate more growth within the economy, which starts with housing. Similarly to what I said about luxury, housing is the first one into a recession and also the first one out of a recession. And so I think you might see some policies to get inventory turnover. Last, two more demand demographics are in our favor over the next 5 years. Baby boomer turnover of inventory, not yet, but forthcoming. Again, demographically segment your databases and start communicating to those people because they're coming from a sales perspective. And millennials are the largest living generation coming of age to acquire real estate. The affordability squeeze can't be lost us nearly 1 million transactions. And then lastly, my comment for 2026 is the Wisconsin advantage. Midwest as a region will continue to grow because of employment and affordability options. Wisconsin unemployment rate at 3.1% is significantly lower than the US average at 4.3%, and we create a very stable environment. Low risk of natural disaster, which low risk of insurance premiums, which creates a lot more things. And then when you look at what's going on within our economic region with what MMAC is doing, the M7 is doing, and the growth from Port Washington to Illinois and the corridor between Milwaukee and Madison, I only think will continue to grow. Means that our region for the long term, I believe, is positioned for us to be able to take advantage of long-term continued growth as it relates to how we perform our fiduciary responsibilities in order to make an income. Make sense? I'm very bullish on it. I think you are all very well positioned to take advantage of it. And if history is an indication of your future, what you were able to survive from 22 to 25 will put you in a position to thrive from 25 to 2030. You hear me? Love it.